Hi everyone, welcome to Vauld's official YouTube channel. So on today's video, we will understand that what 3 steps you can take in order to maximize your returns from your crypto portfolio. These are 3 very important conceptual points that you must know in case you are investing in cryptos. These concepts can also be applied to different asset classes. For example, if you are investing in bonds or if you're investing in real estate or stocks, these conceptual points will definitely make your life easier. Before delving deeper into these 3 conceptual points, let me quickly cover what type of crypto investors are there right now in the market. So there are 3 types of crypto investors in the market. One are called as crypto maximalists. So they would believe that, crypto is everything. That is the only asset class that is going to survive. So imagine if they have $1,000 to invest, they will invest all that money in cryptocurrencies. So these are called as crypto maximalists. Second would be more balanced investors. For example, they would consider cryptocurrency investments to be an asset class. For example, stocks is an asset class, bonds is an asset class, real estate is an asset class. So they would consider cryptos to be one of the asset classes and they will take some kind of balanced positioning in it. Third and finally would be narrative maximalist. So if you delve deeper into the crypto space, there are different types of narratives that go on in the crypto market. For example, some people will say that NFTs are the best. Some people will say that only Bitcoin is the best. Some people will say that only Ethereum is the best. So there are different narratives that people keep on pushing, and many of the investors just only invest in Bitcoin. Their entire saving goes only to Bitcoin. Similarly, many investors invest only in Ethereum. They will be considered as Ethereum maximalist. So these are the 3 prominent typical investors in the crypto domain. Now, I am not trying to criticize any of these investor type. The goal of this video is to help out these balanced types of investors more. So with that viewpoint in mind, let us kickstart our conversation. And the first key core concept that you need to understand to gain maximum from your crypto portfolio is to see the difference and truly understand and imbibe the difference between investing and active trading. So let me very quickly, in simple language, help you understand the difference between investing and active trading. So investing simply means that you have faith on a certain asset class. For example, it could be gold, which is an asset class. It could be stocks or equities, which is an asset class. And within a stock, you might like Amazon or Facebook or Netflix, whichever stock you're bullish about. You would have faith on that stock and you would assume that, the business is really good. I understand the fundamentals. The revenues are going up or profits are going up. Therefore, I'm investing in that particular stock or an asset. So what do you mean when you say investing? Investing typically means that you have picked out certain fundamentals that you like and therefore you are investing in that particular asset. So investing is more fundamental driven. Now when the fundamentals of a company change or when a fundamentals of a certain asset change or when a fundamental of a certain cryptocurrency changes, then you give up on that position and move to a different asset class. That is what investing means. Now, typically, there are different types of investors, but for the purpose of today's conversation, we will consider investing to be one asset class. Some of the key traits of investing is that you are investing your money based on certain fundamentals. You know why you are investing in it. You are confident about that particular asset. You are okay holding that asset till the time the fundamentals do not change. So this is the basic understanding of what investing means. Now, how is it different from trading? Now, trading simply means that you go purchase an asset with the intent of flipping it. Now, flipping simply means that you are trying to exit your position. So let's imagine that you have purchased 1 Bitcoin today and next week, you want to sell this Bitcoin as fast as possible, making a little bit of profit. So that is called as exiting your position. On the flip side, if you have shorted Bitcoin, now that's a slightly advanced trading topic, but in simple language, it means that you are selling some asset tomorrow and you're hoping that the prices will go down. And when the prices go down, you will buy that asset. So that is called as shorting. So many people short assets also. So to cut the long story short, there is a fundamental difference between investing and active trading. When you are active trading, you are trying to exit your position as fast as possible. If you are investing, you are holding on to a certain belief that the asset is good and I'm going to continue to hold it till the time the asset remains good. So now the natural question would be that, okay, should I be investing in cryptocurrencies or should I be actively trading in cryptocurrencies? To each his own. And if you're very good at trading, then please trade, no problem there. But for beginners, it is very important that you start with investing in cryptocurrencies, not active trading in cryptocurrencies. Now, why is that the case? Let me help you understand this by delving a little bit deeper on on active trading concepts. Now in active trading, what happens is that several parameters and technical indicators are used. For example, there are concepts like support, resistance, MACD, RSI. All these technical terms will get confusing for you. So let me take you to Bitcoin's chart and demonstrate some of these points. So here is the Bitcoin USD trading pair, and you will see a lot of red candles and lot of green candles like these. This is called as candlestick pattern, and it gives out technical information. Now this technical information simply says that imagine that this is a red candle. I'm just zooming one of these candles here. This is a red candle. It shows that the price for that one particular day, because we are looking at a day trade here, for that one particular day, the prices of Bitcoin fell. Similarly, this green candle here indicates that the Bitcoin prices started low during the day. So let's imagine 2,500 as the Bitcoin price, hypothetically speaking. And by end of the day, it reached $3,000. So this is what candlestick pattern looks like. And what you would notice is that there are different types of patterns that are getting formed. Now, what is required for these patterns to be correct? Because you are seeing so many red, green candles, but are these candles accurate? Can you discover some kind of data pattern, data analysis out of it? The answer is it depends. It depends on the historic availability of data. If you go to the stock market and if you look at Amazon stock or if you look at Apple stock, what you would notice is that these companies have been trading for a fairly long period of time. Now, since they have been trading for a fairly long period of time, the data or all these technical parameters that you're getting for Apple or Amazon or Microsoft stock, you're getting a lot of historic data. But when it comes to cryptocurrencies, the oldest cryptocurrency is Bitcoin, and even that is roughly 13 years old. So the history of the data associated with it is not too large. So what is the key message that I'm trying to drive home here is, I'm trying to say that if you are doing active trading in cryptocurrencies, it is a very dangerous proposition. Why? Because the quality of historic data is not that high. It is not cryptocurrency's fault. It is simply because of the fact that cryptocurrencies are a newer asset class, and therefore we have limited availability of technical data, and therefore you should not be using too much of technical analysis on cryptocurrencies. I'm not saying that it is completely worthless to apply technical analysis. You can potentially apply some of it, but please don't take major trades just by looking at technical indicators and parameters. You can end up incurring heavy losses, and therefore you should try to become a crypto investor over an active trader, at least when you're starting your cryptocurrency investment journey. The second key concept that will help you maximize your portfolio returns would be understanding the concept of buying the right cryptocurrency. Now, the word right itself is very abstract, so there is no set definition of what right versus wrong is, but the following 4 points can help you understand the context a little bit better. So first and foremost, you must understand the risk-reward equation associated with any type of investment. So let me give you an example here. So for example, you say that, you know what, I want to make like crazy amount of money by next month itself. I want to invest $1,000 and I want to turn it into 50,000 US dollars. Now, it is very unlikely that when it comes to slightly stable cryptocurrencies like Bitcoin and Ethereum, you are unlikely to make such exponential gains. So where do you have to go for this? You would have to probably go and invest in something called as initial coin offerings or initial exchange offerings, which are very early stage crypto projects. So in the stock market world, you would have heard of a term called as IPO, that when companies get listed on NYSE or BSE or NSE or NASDAQ, what are they doing? They are IPOing. They are getting listed on the exchange. And these companies are just starting their stock market journey. So they can go up in prices also quite aggressively and they can fall also quite aggressively. Same concept applies in the crypto world, that if you are going with the assumption that, you know what, I want to make like crazy amount of returns in a very short span of time, then probably investing in something called as ICO or IEOs, initial coin offering or initial exchange offering, might make sense for you. So there, what are you doing? You are essentially analyzing the risk reward equation. On one hand, you are saying that, okay, I want to make crazy amount of returns, but you are also intrinsically understanding that, okay, this is a very risky proposition. So there, probably your risk reward equation balances out. So please understand that whenever you are making any type of crypto investment, please do that risk reward analysis, that if you are taking very high risk, then you should be compensated adequately. If you are taking very low risk, then it is okay not to get compensated very much for it. So this understanding of risk reward framework is very, very critical for you. I will probably make another separate video on how to do risk reward analysis. But for now, try to think yourself that whenever you are putting $100 in the crypto market, Why are you putting it? And what is the risk reward analysis that you're imagining? Let's move on to point number 2, that whenever you are investing in a cryptocurrency, the value of that cryptocurrency should be clear to you. There should be some kind of fundamental basis as to why you are investing in it. So let me give you an example here. For example, let's pick something like Bitcoin, now which is one of the most prominent cryptocurrencies. Now, what is the value of a cryptocurrency like Bitcoin? If you study cryptocurrency, and where can you study cryptocurrency? You can study cryptocurrency by analyzing its white paper. Where do you find the white paper? You either find it on Bitcoin's website, or you can go to a website called as coinmarketcap.com and you can download the white paper from there. So on the white paper, and white paper is nothing but a research paper associated with Bitcoin, you read through it, you understand what the value of Bitcoin is, and you will be able to ascertain that the major value add of Bitcoin is its limited supply. So it acts as a hedge against excessive currency printing. And you might have also observed it that in 2020 and in the early part of 2021, when excess currency was printed, Bitcoin went up very high in value. Why? Because people were looking to put their money in assets which will not be eaten away by inflation. So that is the value add of Bitcoin. In case you want to learn more about Bitcoin, please watch my previous video here. It will help you understand more. So similarly, irrespective of which cryptocurrency you are putting your money in, please understand the value of that cryptocurrency. Now comes the third point, that whenever you are purchasing any cryptocurrency, please ask yourself the question that does it fit with your portfolio? In 2020, you must have seen a lot of people making profits in cryptocurrencies, becoming overnight crypto millionaires, etc., etc. And you would have gotten lured that, okay, new currency in town, let me go and invest my money in it. Please don't do that. Please understand that whether that cryptocurrency fits your portfolio or not. Let me give you an example there. For example, Dogecoin is a meme coin and a community coin. A lot of people purchased Dogecoin and it became one of the biggest cryptocurrencies out there simply because of the fact that it had a cool question to it. It sounds fun. A lot of people were promoting it. It had a cute symbol, whatnot, right? So that was a meme coin. It was a fun coin. Now, if you already hold Dogecoin, then another cryptocurrency comes in town. For example, Shiba Inu. So now you invest your money in Shiba Inu also. Then third currency comes in town. You invest your money in that same currency also. So the point is that you are purchasing similar set of currencies. Now, if for some reason these meme coins go down in value, then Dogecoin will also go down. Shiba Inu will go down, and accordingly your portfolio will also go down. So it is very important to balance your portfolio. Then comes the fourth and final tip, which is that you should avoid scam coins. Now, the crypto world is extremely decentralized. Decentralization simply means that there is no authority that is there on your head. You get a lot of autonomy. Now, this can be both a pro and a con to cryptocurrencies. The primary advantage of being decentralized is that you get to make a call how much to buy, when to buy it. No one is regulating you. So these are good things because you get a lot of freedom. On the flip side, the disadvantage is that there is no central authority managing the process and protecting you. So the responsibility of protecting yourself falls on you. So therefore, it is very important to understand whether certain cryptocurrencies are a scam or not, because in the decentralized world, a lot of new coins can come up. They can announce that we are doing a token round. Please come and invest with us. Please do not fall into trap without doing your due diligence. Now, how do you do a basic due diligence? Please go read a white paper. Please go join their Discord or Twitter or Telegram community. Look at the quality of conversation that is happening. And if you just follow the founders, what type of work they are doing, whether the white paper makes sense or not, if you do these basic hygiene checks, at least 90% of the crypto scam projects you can do away with. So this is the second broad criteria that you need to remember. The third and final concept that you need to remember to maximize your gains from crypto portfolio is that you must hedge your portfolio. So what exactly is hedging? So let me explain that by using an example. So you might have seen that big investors, what they do is that they buy a little bit of equity. They buy a little bit of bonds. They buy a little bit of cryptos. So what are they doing? They are basically balancing their portfolio. They are putting their money across different asset classes. Here I have named 3 asset classes. Similarly, you would have noticed very recently that when the stock market and the crypto market went down, the gold market went up and the gold prices went up. So a lot of people put gold also as an asset class into their portfolio. So this entire strategy of building a portfolio, or rather building a balanced portfolio, is called as hedging. This is just one way of hedging your portfolio. There are numerous techniques of hedging. So let me talk about some easy to implement hedging strategies in the cryptocurrency world. So first and foremost, as a normal retail investor, you can invest across different asset classes. That can be option one. Now, if you're a crypto maximalist, you would say that, you know what, all my money needs to go to crypto, and you are not incorrect. That is completely fine. You can adopt strategy number 2 and strategy number 3. So strategy number 2 is that identify different types of good cryptos that have different use cases. For example, the use case of Bitcoin is very different from the use case of Ethereum. So that way, at least split your money. Similarly, whatever other good cryptocurrencies you find, you can take positions in it. Third and finally, please invest in a staggered timeline manner. For example, it should not happen that, hey, you know what, Bitcoin fell by 30% today, so I'm going to sell my house and invest all my money in Bitcoin in one go. That can prove to be extremely dangerous. So there is a concept called as SIP, or systematic investment plan. Now, according to SIP, what you simply do is that you pick a date on which you are going to make an investment, or you pick a couple of dates in a month. So let's assume that you are picking 12th and 27th as 2 days in which you are going to make cryptocurrency investments. So you keep on investing an allocated amount of money, whether the market is going up, whether the markets are going down, and you stick to that rule of investing on 12th and 27th of every month, irrespective of the market performance. So what is the advantage of that? So let me demonstrate that on Bitcoin's chart. So for example, let's say that you started investing at the peak of 2018 in Bitcoin, and every month you invested $100 in it. So every single dot indicates $100 investment, right? So let us consider this dot number 2 and dot number 1. Now, what is the difference between dot number 1 and dot number 2? So here, since you are investing $100 worth of Bitcoin, you are buying less of it because the Bitcoin prices are higher here. And here, because the Bitcoin prices are low, and if you are still investing $100 in it, you get to purchase more quantity of Bitcoin. And in the long term, what is happening? The trend is this. So your investment portfolio ends up giving average return. And look at the overall return of Bitcoin since its inception. So it has been going up and up and up. And you could have benefited just by doing systematic investment plan in something like Bitcoin or any other cryptocurrency that you have faith on. So I hope you enjoyed this video. Do let me know in the comment box which of these 3 strategies fit best with your investing style. I would love to hear from you, and I will see you the next time.